Did you know that a single institution has the power to influence the value of the money in your pocket, the interest rate on your car loan, and even the health of the entire global economy? And no, it's not a shadowy organization from a spy movie. It's the US Federal Reserve. And here's a fact that might surprise you. The Fed doesn't actually print money. That's the job of the Treasury Department. But what the Fed does is far more powerful. It controls the supply of money, and that changes everything. In the next 10 minutes, you will thoroughly understand what the Federal Reserve is, how it wields its immense power, and most importantly, how its decisions create ripples that affect your personal finances and investment portfolio. By the end of this video, you'll be able to analyze the Fed's actions like a seasoned financial professional. Chapter 1. The Architect of the Economy. So, what is the Federal Reserve, or the Fed, as it's commonly known? Imagine the economy is a massive, complex engine. The Fed is the master mechanic, constantly tuning it to run smoothly. Established in 1913, its primary purpose was to create a more stable and secure financial system in the United States. Before the Fed, the country was plagued by frequent financial panics and bank runs. There was no central authority to ensure that banks had enough cash to meet customer withdrawals. The Fed was designed to be the lender of last resort, a backstop for the banking system. But its role has evolved significantly since then. Today, the Fed has a dual mandate from Congress to promote maximum employment and to maintain stable prices. In simple terms, it tries to keep the economy from getting too hot or too cold. It wants as many people as possible to have jobs, but it also wants to prevent inflation, the rate at which the cost of goods and services rises, from spiraling out of control. It's a delicate balancing act, and the Fed is the one walking the tightrope. Chapter 2. The Fed's Toolbox. Now, how exactly does the Fed control the engine of the economy? It has a powerful set of tools at its disposal. Let's break them down using the TAE model: theory, analogy, and example. Theory. The most well-known tool is the federal funds rate. This is the interest rate that banks charge each other for overnight loans. While you and I don't deal with this rate directly, it's the foundation for almost every other interest rate in the economy. Analogy. Think of the federal funds rate as the wholesale price of money. Just like a lower price for raw materials means cheaper products for consumers, a lower federal funds rate means lower interest rates on things like your mortgage, credit cards, and business loans. Example. Let's say the Fed wants to stimulate the economy. It will lower the federal funds rate. This makes it cheaper for banks to borrow money, so they, in turn, lower the interest rates they offer to customers. With lower mortgage rates, more people can afford to buy homes. With lower business loan rates, companies are more likely to invest in new equipment and hire more employees. This increased spending and investment boosts the entire economy. A financial advisor would tell you that a low-interest rate environment can be a good time to refinance your loans or consider investments that benefit from economic growth. Another powerful tool is quantitative easing, or QE. Theory. During a severe economic downturn, when simply lowering interest rates isn't enough, the Fed can resort to QE. This involves the Fed buying large quantities of government bonds and other financial assets. Analogy. Imagine the economy is a car with a nearly empty gas tank. Lowering interest rates is like tilting the car to get the last few drops of fuel. Quantitative easing is like having a gas can and directly pouring fuel into the tank. The Fed is injecting money directly into the financial system. Example. During the 2008 financial crisis, the Fed initiated several rounds of QE. By purchasing trillions of dollars in bonds, it increased the money supply and lowered long-term interest rates. This helped to stabilize the fragile banking system, and encourage lending and investment, ultimately preventing a much deeper recession. This has a profound impact on wealth management strategies, as it can significantly influence the performance of different asset classes in your investment portfolio. Now, I have a question for you. How do you think the Federal Reserve's interest rate decisions have personally affected your financial life? Let me know in the comments below. Chapter 3. Navigating the Fed's Moves. Understanding the Fed is one thing, but how do you use that knowledge to your advantage? First, let's talk about a common pitfall: overreacting to the headlines. The Fed's decisions are often anticipated by the market weeks, if not months, in advance. A small interest rate hike, for instance, is unlikely to tank the stock market overnight if it was already expected. The real danger is making impulsive decisions based on fear or speculation. Now, for a professional tip: learn to read the Fed's signals. The Federal Open Market Committee, or FOMC, which is the body within the Fed that sets monetary policy, releases a statement after each of its 8 annual meetings. These statements are meticulously crafted and offer clues about the Fed's future intentions. Financial professionals pay close attention to the language used. A single word change can signal a shift in the Fed's thinking and have a significant impact on the market. For example, if the Fed's statement shifts from saying it expects to raise rates to it anticipates raising rates, that subtle change can indicate a stronger and more imminent intention to do so. By understanding these nuances, you can position your investment portfolio more strategically. In a rising interest rate environment, for example, you might consider shifting some of your assets into sectors that tend to perform well in such conditions, like financials, or into shorter-term bonds that are less sensitive to interest rate changes. This is a level of analysis that can significantly improve your credit score and overall financial health in the long run. Synthesis. So, let's distill this down to the 3 most important takeaways. First, the Federal Reserve is the central bank of the United States, and its primary role is to manage the country's monetary policy to achieve maximum employment and stable prices. Second, the Fed's main tools are the federal funds rate and quantitative easing, which it uses to influence interest rates and the money supply, thereby steering the economy. And third, by understanding the Fed's actions and communications, you can make more informed financial decisions and avoid common pitfalls, ultimately helping you to build and protect your wealth. If this video provided you with real value, invest one click on the subscribe button to get daily access to the code. Knowledge is the new capital. See you tomorrow.